While Guyana drills deeper and expands its oil empire at breakneck speed, the International Monetary Fund is quietly sending a warning to Trinidad and Tobago. Tighten spending, raise rates, or risk mounting pressure on the currency. That contrast alone tells you everything about where the Caribbean economic story is heading in 2026. On one side, explosive oil-driven growth, surging revenues, and global energy giants racing to secure long-term positions. On the other, a mature energy producer working to defend its currency, stabilize reserves, and navigate a more complex financial environment. This is not just a story about budgets or exchange rates. This is a story about regional power, investor confidence, and the shifting balance of the Caribbean energy market over the next decade. For decades, Trinidad and Tobago stood as the Caribbean's undisputed energy heavyweight. The country built a powerful industrial base around natural gas, becoming one of the world's key LNG exporters and a major petrochemical hub. Its refineries, export infrastructure, and technical expertise gave it economic influence few neighbors could match. But the landscape is changing. Economic growth has slowed. Expansion has remained modest, hovering below dynamic levels that typically attract large waves of new capital. Slow growth does not immediately signal crisis, but it does make fiscal management and currency stability far more challenging. According to signals highlighted by the International Monetary Fund, three interconnected pressures are shaping the outlook: declining foreign reserves, persistent fiscal deficits, a tightly managed exchange rate system. To maintain exchange rate stability, the central bank has been supplying US dollars into the domestic market. This helps businesses operate smoothly and prevents sudden currency volatility. However, each intervention gradually reduces foreign reserve buffers. Only a few years ago, reserves stood comfortably above $6 billion US. Today, those levels are trending downward, and projections suggest continued pressure if policy settings remain unchanged. Why does this matter? Because confidence in a managed exchange rate depends heavily on reserve strength. If investors begin questioning whether that buffer remains sufficient, demand for foreign currency rises rapidly, and market pressure accelerates. That is why the IMF is encouraging tighter fiscal discipline and potentially higher interest rates. These measures are not just technical adjustments, they are signals to global markets that financial credibility remains intact. Public debt levels are another key factor. Fiscal deficits have remained elevated relative to government targets, meaning policy adjustments may eventually become unavoidable. Potential reforms include reducing non-targeted subsidies, expanding the tax base, improving state enterprise efficiency, strengthening long-term fiscal sustainability. These steps are economically logical, but politically sensitive. Now contrast that situation with Guyana. Guyana is currently experiencing one of the fastest oil-driven economic expansions in the world. Massive offshore discoveries continue to transform the country's financial outlook. Production growth is accelerating, infrastructure investment is surging, and international capital is flowing into new projects at record speed. This is the classic early cycle energy boom phase. Government revenues are rising rapidly. Public investment is expanding. Global investors see momentum, and momentum attracts more momentum. That does not mean risks do not exist. Rapid expansion can create inflation pressures, infrastructure bottlenecks, and governance challenges. But for now, the narrative is overwhelmingly growth-focused rather than stability-focused. And this is where the regional competition story becomes powerful. Investors comparing Caribbean energy opportunities are increasingly looking at trajectory, not just history. Trinidad and Tobago still holds major structural advantages: established LNG export infrastructure, deep technical expertise, Mature industrial supply chains. New offshore exploration potential. Several upcoming projects could strengthen production levels over the next few years. If those developments materialize at scale, growth momentum could return. But until that acceleration appears clearly in macroeconomic data, financial pressures remain part of the conversation. The IMF's message effectively outlines two strategic paths. Number 1. Maintain the current exchange rate framework and defend it aggressively. This would require tighter fiscal policy and potentially higher interest rates to reduce capital outflow risks. Number 2. Allow greater flexibility over time while gradually rebuilding fiscal buffers and strengthening reserves. Neither option is easy. Higher interest rates can stabilize currency expectations, but they also increase borrowing costs for businesses and households, potentially slowing investment and consumption. Too loose, and reserves fall faster. Too tight, and growth slows further. Meanwhile, Guyana's rapid expansion continues to reshape investor expectations across the region. The Caribbean energy map is no longer static. It is being rewritten in real time. The next 5 to 10 years will determine whether Trinidad and Tobago successfully transitions into a modernized energy economy, or whether Guyana's oil boom permanently shifts the center of gravity in the region. Because in global energy markets, momentum matters. And right now, the momentum story is becoming impossible to ignore.